Welcome back, fellow value investors. In this video, I'm going to be reviewing my bond portfolio, reviewing where bonds have been in the last 30 days. And it's been a pretty wild ride with interest rates really rising and then coming down very quickly. Interest rates have a big effect on bonds, and I'll be taking a look at how bonds were affected over the last 30 days. I'll take a look at a few investments that I have and share examples of yields that I'm achieving with bonds. Do me a favor and like my video if you like videos like these, and subscribe to my channel. I'd really appreciate that. And please leave a comment. Would love to hear from you and your thoughts on this video as well as bonds overall. There's a few reasons why I have a bond portfolio, and I have goals around my bond portfolio. First, it's to diversify with bonds. I have a lot of stocks. I own real estate as well. And with bonds, I could have an asset class that has less volatility and a more defined return, which is attractive to me. I'm trying to achieve positive returns of 5 to 12% on any one bond that I buy, because I want to generate consistent cash flow and get good at being able to have a defined cash flow in the future as I look at retiring. Looking at the 10-year Treasury, which is typically the most looked at yield in the bond market, I'm looking at the last 5 years, and you could see that it was going down, especially when we hit COVID. The Federal Reserve really lowered rates and really brought rates down to almost zero. It was pretty much, bonds were uninvestable. This zone here was just, why would you buy a bond if it was guaranteeing you a 1% return or a 2% return? It was just way too low. And as bonds began to see that big rate rise, they began to get interesting. You know, right around this zone it gets interesting, because now you're looking at yields of 3.5 on really good quality bonds, short term, and you're looking at really more aggressive returns as you go up in risk as well as term. And more recently, we saw a big rise and then a big fall in interest rates, which got really interesting. Overall, over the last year to date, I should say, the return on my bonds is 6.77, which I'm very happy with. And that includes the yield in the form of interest, as well as my bonds actually gained value in 2023. So when I combine the two, almost a 7% return. I'm very happy with that. Again, because bonds tend to be more defined with regard to their income. And I think I've learned a lot over the last 2 years, which is going to benefit me. As I look at retiring, I could use bonds to really set up good cash flow for my living expenses. So it's been a good 2 years of investing in bonds, and I'm happy with my return. Let me focus on the last 12 months and make a couple of observations. The first one is that we saw a big rise in interest rates. They went from, low threes up to 5% on the 10-year Treasury, which is a huge rise. And as you see interest rates rise, the bond value goes down. What you would pay for that bond would go down while the yield is going up. It's a real good time to be buying. And in my opinion, averaging in my buy on these bonds, because I was able to grab some bonds that were paying at the high or near the high of this yield. So I was very happy with those. Now that we're seeing the opposite, which is, hey, interest rates are dropping, and they drop very fast from nearly 5% down to 4.4%. Well, bond values, they go up. The actual value of that bond goes up while the yield is going down. So we're seeing this down move. Is it going to continue? I don't know. I think the Federal Reserve has said they're going to keep rates high for longer. I don't see any big causal factors that are going to affect interest rates in the next 6 months, but we'll see. But for now, I think averaging my purchase of bonds is a good idea, as the market really has volatility in the interest rate. I wanted to share a few examples of the bonds that I've purchased, as well as an ETF that I buy into. And before I do so, I just want to remind everybody, I'm not recommending any of these investments. They're just examples of what I'm doing. I'm just sharing my experience. So first, let's talk about Exxon. So Exxon, this is a short-term, short duration, and high quality bond. It's paying 5.2%, and it redeems in March 19th of 2025, meaning they'll give me the face value of that bond as well as interest payments until then, but they'll give me the face value of that bond on this date. So that's a pretty good yield, and it's probably a little higher than a savings account. I think high yield savings accounts are paying up to about 5%. And you got to check the terms and conditions. You always have to do that because banks will advertise something that is sometimes catchy, but they may trick you into getting less than what they're advertising. I'm also looking at a short-term bond ETF from Vanguard, symbol is BSB, and it has a 30-day yield of 5.14. So buying individual bonds is difficult. What's very liquid is these ETFs. You can get in and out very easily. But I do both, and I'm mostly an individual bond buyer because I think I get a better yield and I'm going to perform better. But it's just more difficult. Now, as we add duration, we're adding risk. We're going to have a bond with a company for a longer period of time, so there's more risk. And I'm looking at a bond issued out by Citigroup. It will redeem on July 25th, 2028. So let's call it almost 5 years from now, less than 5 years from now. And it pays about 5.8% yield to maturity. That's a pretty good rate. Another way to think about this is, I know that high yield savings accounts are paying near 5%. That's not guaranteed it's going to be available in a year or 2 years. And this way you can lock in 5.8% on a bond. So I like this bond. I've been buying more of these bonds and building a really, really good sized position of Citigroup. And ETFs are available for intermediate term bonds. And here's one from Vanguard. It has a 30-day yield of 5.2%. And it's very easy to get in, very easy to get out of that particular ETF. The last example is the riskiest, but it also pays the most. And that's a bond issued out by Petróleos Mexicanos. That's a petroleum company down in Mexico. And Mexico's economy is doing really well. And obviously, oil companies tend to be cash rich. And in this case here, I think there is risk, but it's not an overly risky company that's issuing out the bond. The duration of this bond is going to be about a little over 6 years. And so the duration is higher. The credit rating is lower than, let's say, an Apple or a Microsoft, but it pays over 11% as a yield to maturity. So that's a pretty attractive rate. I'm very comfortable with this oil company. I've tracked it for a long time. So I've built a pretty big position with this particular bond because I think that 11% is pretty attractive. You could also buy an ETF for long bonds. And currently, the last 30 days, the ETF from Vanguard, symbol BLV, has a yield of 5.44% over the last 30 days. Just going over my goals, there's an intent with my bond portfolio, and part of it is my age. I'm approaching retirement, early retirement, and I want to learn how to create income. I love my stocks. I love my real estate assets that I've invested in. I have investment properties, but you can't get cash out of real estate very easily. And some stocks, are growth stocks. So I like to see them grow, and I can't really milk them for any income, but bonds are really good for income. And I can have a good portfolio that's going to generate that income that I like. It's also diversification for my portfolio, which I really think is a good idea. And really the positive returns, are there. I think they're very reasonable returns. Again, I'm not aiming to match stock returns because I think stocks, are more riskier, more volatile, and therefore investors, are looking for a higher return. But bonds are lower risk, The return is lower, but right now it's attractive based on the proposition of risk to return. So that's my video on bonds. I hope you found it interesting. Love to hear your thoughts on what you're doing with bonds and what you think of these interest rates.